In 1720, the British government helped inflate one of the largest financial scams in history. It promised national prosperity. It promised debt relief. It promised access to the riches of South America. Instead, it converted public trust into speculative frenzy. Members of Parliament bought in. Aristocrats bought in. Ordinary citizens followed. Share prices exploded from confidence alone. There was no real trade, no real revenue, only a promise backed by political endorsement. When the bubble collapsed, fortunes vanished. This was not simply a market mistake. It was a government-backed scam. This is the South Sea Bubble. Britain entered the 18th century under financial strain. The War of the Spanish Succession, fought from 1701 to 1714, imposed extraordinary fiscal pressure on the crown. Sustained military campaigns across Europe required continuous borrowing. By 1710, Britain's national debt had risen to approximately £50 million. For a population of roughly 5 million people, this level of debt was unprecedented. Interest payments consumed a significant portion of annual government revenue. The state relied on long-term bonds sold to private investors. These bonds carried fixed interest obligations that had to be serviced regardless of economic conditions. Managing them required constant refinancing. The system functioned, but it was structurally fragile. Government debt was fragmented across multiple instruments with different maturity dates. Some bonds traded below face value. Others were difficult to resell. Administrative complexity increased uncertainty. Investor confidence became the foundation of national solvency. Many creditors had already committed substantial portions of their wealth to government securities. Market appetite for additional bond issuance began to weaken. Yields fluctuated as demand shifted. The government required lower servicing costs. It required consolidation. It required renewed investor enthusiasm. Tax increases were politically sensitive and socially unpopular. War fatigue had spread across the country. Economic growth was uneven. London's financial markets were expanding, but still lacked mature safeguards. Speculation existed. Oversight remained limited. The Bank of England, founded in 1694, had stabilized certain aspects of public credit. It had not eliminated structural pressure. Britain's fiscal model depended on confidence. Confidence depended on the perception of long-term repayment capacity. If bondholders doubted solvency, borrowing costs would rise. If borrowing costs rose, fiscal strain would intensify. By the early 1710s, the government needed innovation, not military innovation, financial innovation. The solution would not eliminate debt, it would restructure it. It would convert fixed obligations into equity. It would transform creditors into shareholders. Before the bubble formed, the system was already unstable. Debt pressure created vulnerability. Vulnerability made experimentation politically attractive. The foundation of the South Sea Bubble was built on national financial strain. In 1711, the South Sea Company was created by Act of Parliament. It was presented as a solution to Britain's debt burden. The proposal was engineered by Robert Harley, then Chancellor of the Exchequer. The structure was simple in appearance. Holders of government bonds would exchange their debt for shares in a new joint stock company. Instead of receiving fixed interest from the state, investors would receive dividends from corporate profits. The government would transfer a large portion of its debt obligations to the company. In return, the company would assume responsibility for servicing that debt. The state reduced immediate pressure on its treasury. Bondholders were offered the possibility of higher returns. The arrangement converted creditors into shareholders. It transformed public debt into speculative equity. By 1711, approximately $9 million of government debt was targeted for conversion. The company received the right to trade exclusively with Spanish South America. This was described as access to immense untapped wealth: gold, silver, sugar, slaves. The promise of monopoly implied limitless expansion. Political endorsement reinforced credibility. Members of Parliament publicly supported the scheme. The Crown granted a royal charter. The South Sea Company appeared both commercial and patriotic. It was framed as a national recovery project. The structure resembled financial innovation. In practice, it was a debt management strategy dependent on rising share value. The company's real trading capacity was secondary to its financial function. Debt consolidation was the primary objective. Trade was the narrative vehicle. The mechanism depended on confidence. If share prices rose, conversion would accelerate. If conversion accelerated, government debt would consolidate further. The success of the company required public belief in future profits. That belief rested on distant markets few British investors understood. The Spanish Empire tightly controlled South American commerce. Negotiated access was limited. Operational constraints were significant. Yet the institutional backing masked these limitations. The South Sea Company was not launched as a trading powerhouse. It was launched as a financial instrument. Its foundation was political design. Its expansion would depend on market enthusiasm. The restructuring appeared orderly. The incentives beneath it were volatile. The South Sea Company's promise centered on trade with Spanish South America. The scale of that promise exceeded political reality. Spain controlled nearly all major ports in the region. British merchants did not possess open commercial access. Under the Treaty of Utrecht in 1713, Britain secured limited rights. The most significant concession was the Asiento contract. This granted Britain the right to supply enslaved Africans to Spanish colonies. It also allowed one annual trading ship, one ship per year. This was not an open trading corridor. It was a narrow, highly regulated arrangement. Spanish authorities restricted port access and customs procedures. Inspection regimes were strict. Delays were common. Confiscations were possible. Profits depended on cooperation from a rival empire. Logistics were expensive. Transatlantic voyages required long sailing times. Mortality rates among enslaved captives were high. Insurance costs were significant. Administrative overhead reduced margins. The scale of potential profit was frequently exaggerated in London. Pamphlets described South America as a reservoir of gold and silver. In practice, bullion extraction was tightly controlled by Spain. The South Sea Company never gained mining rights. It never gained territorial authority. It relied on negotiated commercial privileges. Between 1713 and 1719, actual trade revenues were modest. The Asiento trade produced limited returns relative to expectations. The annual trading ship often faced delays and restrictions. Smuggling attempts increased tension with Spanish officials. Diplomatic relations fluctuated. Commercial stability was fragile. By 1718, Britain and Spain were again in conflict. War disrupted even the limited trade that existed. The company's share price did not reflect these operational constraints. Investors in London focused on projected expansion. Few examined shipping manifests. Few calculated net margins after transport, insurance, and political risk. The narrative of boundless South American wealth persisted. The operational reality remained narrow. The promise of monopoly masked structural limitations. The South Sea Company's valuation was anchored less in revenue than in imagination. Expectation replaced evidence. The gap between story and balance sheet widened. Confidence continued rising despite constrained trade. The illusion was not that trade existed. The illusion was that trade would scale without limit. Market enthusiasm detached from commercial output. The company functioned increasingly as a financial asset rather than a trading enterprise. Revenue did not justify valuation, yet valuation continued to rise. The divergence was visible. It was not widely acknowledged. By early 1720, the South Sea Company shifted from trade narrative to price engineering. The objective was no longer commercial expansion, it was share acceleration. In January 1720, the company proposed to absorb the remaining national debt. This second conversion plan targeted more than $30 million in government obligations. Parliament approved the proposal. The scale of restructuring increased dramatically. To finance the conversion, the company issued new shares. These shares were offered on installment terms. Investors could subscribe by paying a fraction up front. The remainder would be due later. This structure expanded access. It also expanded leverage. Buyers committed to large positions with limited immediate capital. Rising prices made installment payments appear manageable. Each price increase validated the previous one. In February 1720, shares traded around £128. By March, they exceeded £300. By April, they approached £550. Momentum replaced valuation discipline. Directors understood the psychological effect of rapid appreciation. They facilitated it. Company loans were extended to investors to purchase additional shares. Credit fueled demand. Demand fueled price. Price fueled confidence. Confidence attracted new buyers. The cycle became self-reinforcing. Promotional campaigns intensified. Pamphlets described guaranteed prosperity. Rumors circulated of imminent trade breakthroughs. Public perception detached further from operational performance. The company's real earnings did not justify the surge. Dividend expectations were speculative, yet the stock continued rising. In June 1720, shares approached £1,000. Paper wealth multiplied across London. The higher the price climbed, the more credible the enterprise appeared. Valuation became proof. Few questioned underlying cash flow. Few examined debt servicing realities. Liquidity depended on continued inflows. The company's directors did not discourage excess enthusiasm. They structured it. Installment subscriptions created future payment obligations. If prices fell, those obligations would strain investors. At the peak, leverage was embedded across the system. Debt had been transformed into equity. Equity had been amplified by credit. Price engineering replaced productive output. The mechanism was no longer subtle. It was mechanical escalation. The system required perpetual appreciation. Any interruption would expose fragility. As share prices accelerated, political participation intensified. The South Sea Company was not operating at arm's length from government. It was intertwined with it. Members of Parliament were offered shares on preferential terms. Some received allocations before public subscription opened. Others were granted installment flexibility unavailable to ordinary investors. These arrangements were discreet. They were also influential. By 1720, more than 100 members of Parliament held South Sea stock. Senior ministers were directly exposed. The Chancellor of the Exchequer was connected to the scheme. The Postmaster General held shares. Even the Lord Treasurer Circle participated. The alignment of political authority and speculative interest reduced oversight. Criticism carried reputational risk. Opposition implied disloyalty to a government-endorsed recovery plan. Directors cultivated this protection deliberately. They distributed stock to influential figures at favorable prices. They extended credit to political allies. They converted legislators into stakeholders. Parliamentary approval for the second debt conversion did not occur in isolation. It occurred in an environment of shared financial interest. Regulatory restraint weakened. Warnings were muted. Questions about trade revenue received limited attention. The company's directors understood perception management. They released optimistic statements. They reassured Parliament that trade expansion was imminent. Share price stability became a political priority. When smaller bubble companies began forming in 1720, Parliament passed the Bubble Act. The act was framed as consumer protection. In practice, it restricted competing joint stock ventures. The South Sea Company faced less competition as a result. Political intervention protected its dominance. The conflict of interest was structural. Legislators regulating speculation were simultaneously profiting from it. Public trust in government endorsement amplified investor confidence. Few retail participants understood the depth of insider alignment. They saw parliamentary backing. They assumed institutional credibility. Inside the system, price appreciation benefited decision-makers directly. The higher the shares climbed, the more valuable political portfolios became. Private gain aligned with public policy. Oversight became compromised by participation. The South Sea Bubble was not merely tolerated by government, it was embedded within it. The boundary between state and speculation dissolved. Institutional authority shielded financial engineering. At the height of the rise, political legitimacy reinforced market euphoria. Protection from scrutiny delayed correction. The incentives were no longer neutral, they were conflicted. When the correction arrived, exposure would reach beyond investors. It would reach Parliament itself. By the spring of 1720, speculation expanded beyond political circles. The South Sea rise became a public phenomenon. Coffee houses transformed into informal trading floors. Exchange Alley overflowed with new participants. Middle-class merchants entered aggressively. Clerks invested savings. Widows committed inheritance funds. Servants pooled wages to buy fractions of shares. The belief was simple. If Parliament supported it, the risk was limited. Share prices had risen from £128 in January to over £500 by April. Momentum appeared unstoppable. Paper profits circulated through conversation. Early investors displayed sudden wealth. Carriages were upgraded. Country estates were purchased. Visible consumption reinforced confidence. Imitation followed success. Subscription lists filled rapidly. Demand outpaced supply. Speculation detached from fundamentals. At the same time, new ventures emerged. Entrepreneurs launched competing bubble companies. Some promised trade with distant colonies. Others promised inventions without explanation. One proposal famously offered a company for carrying on an undertaking of great advantage, but nobody to know what it is. Capital flowed toward novelty. Regulation struggled to keep pace. In June 1720, dozens of new joint stock promotions circulated in London. The appetite for risk widened. Credit became common. Shares were purchased on borrowed money. Installment obligations multiplied. Market participation expanded beyond financial sophistication. Few participants read company balance sheets. Fewer understood debt conversion mechanisms. Most responded to price direction. The higher shares climbed, the safer they appeared. Confidence replaced calculation. By mid-1720, the South Sea price approached £1,000. The valuation bore little relation to trade revenue. Yet public enthusiasm intensified. Crowds gathered daily in Exchange Alley. Rumors moved faster than documentation. Optimistic pamphlets outnumbered cautious analysis. Speculation became social behavior. Participation signaled intelligence and modernity. Skepticism signaled hesitation. The culture shifted from investment to expectation. Liquidity depended on continuous inflow. Each new buyer validated the previous one. The bubble was no longer confined to elites. It had become national. The structure required perpetual optimism. The base of participants was widening. The underlying revenue was not. The imbalance was growing. By the summer of 1720, the South Sea share price approached its peak. In late June and early July, it traded near £1,000. The valuation implied extraordinary future profit. The company's actual revenue did not justify that level. Trade with South America remained limited. Shipping volume had not expanded proportionally. Dividend capacity was uncertain. Installment obligations, however, were real. Thousands of investors owed future payments on subscribed shares. Many had borrowed to finance their positions. Credit exposure was widespread. Liquidity depended on continued buying. If new investors slowed, price momentum would weaken. The market structure required constant inflow. Early participants could sell at high prices. Later participants relied on resale to others. The chain lengthened. Confidence became the central asset. Directors attempted to maintain stability. They issued reassuring statements. They supported the market through controlled transactions. But supply began to increase. Some insiders quietly reduced exposure. Profit-taking introduced downward pressure. Price fluctuations became visible. In August 1720, shares slipped below £900. The decline appeared modest. It was not interpreted as structural. Yet installment deadlines were approaching. Investors needed cash. Some sold to meet obligations. Selling generated more selling. Credit tightened. Lenders demanded repayment. Confidence, once expansive, became fragile. Rumors shifted tone. Instead of limitless wealth, conversation focused on risk. Liquidity thinned. Bid-ask spreads widened. Market depth diminished. As prices fell towards £700, anxiety intensified. The system had no earnings floor. It had price expectation. Without continued appreciation, leverage became dangerous. Debt servicing pressure reemerged in new form. Government restructuring had converted public debt into private exposure. The fragility was mathematical. The share price required belief. Belief required upward movement. Upward movement was slowing. The peak masked vulnerability. The foundation had not strengthened. It had stretched. The system now depended on stability it could not guarantee. The correction had not yet accelerated, but the pressure was building. In September 1720, confidence broke. Selling intensified rapidly. Investors who had purchased near the peak rushed to exit. Buyers hesitated. Liquidity evaporated. Share prices fell sharply below £800, then below £700. Margin calls accelerated pressure. Installment payments became unmanageable. Creditors demanded repayment in cash. Cash was scarce. Speculators sold other assets to cover losses. Government bonds were liquidated. Land was pledged. Personal estates were mortgaged. The downward movement fed on itself. Each decline reduced collateral value. Reduced collateral forced additional selling. Directors attempted stabilization measures. They proposed support arrangements with the Bank of England. Temporary agreements were discussed. Confidence did not return. By late September, the share price collapsed toward £400. Within weeks, it fell near £150. The paper wealth of early summer vanished. Fortunes calculated at £1,000 per share were erased. Installment subscribers remained liable. Debt obligations persisted even as prices fell. Exchange alley shifted from celebration to panic. Crowds gathered not to subscribe but to sell. Rumors of insolvency spread. Private bankruptcies multiplied. Credit networks strained. Trust between lenders and borrowers deteriorated. Some investors fled London. Others concealed losses. The scale of exposure became visible. Aristocrats were affected. Merchants were ruined. Clerks lost savings. Widows lost inheritance funds. The government faced reputational damage. It had endorsed the company. It had facilitated debt conversion. Now public anger intensified. The collapse was not gradual, it was decisive. The structure that required perpetual appreciation could not withstand reversal. Liquidity had sustained the rise. Illiquidity accelerated the fall. The South Sea bubble had burst. The mechanism that amplified wealth now magnified loss. The correction exposed leverage embedded across society. Confidence had been the foundation. Confidence had failed. The collapse produced immediate social shock. Losses were not confined to speculators. Aristocratic families saw estates destabilized. Members of parliament faced financial exposure. Merchants declared bankruptcy. Credit chains fractured. By October 1720, the share price had fallen below £200. At its lowest point, it approached £100. Investors who had purchased near £1,000 faced catastrophic loss. Installment subscribers still owed payments. Debt obligations did not disappear with valuation. Private insolvencies increased rapidly. London's credit market tightened. Lenders became defensive. Trust between counterparties weakened. Confidence in joint stock ventures deteriorated. The impact extended beyond London. Provincial investors suffered parallel losses. Inheritance funds were depleted. Retirement savings vanished. Commercial contracts were cancelled. Consumption slowed. Anger intensified. Pamphlets accused directors of manipulation. Public gatherings demanded accountability. Attention shifted toward Parliament. Government endorsement had legitimized the scheme. Now legitimacy was questioned. Investigations were announced. Committees were formed. Records were requested. Correspondence between directors and ministers was examined. Financial books were opened to scrutiny. Evidence of preferential share allocations emerged. Political participation became visible. The perception of insider advantage fueled resentment. The crisis moved from market failure to institutional scandal. Trust in governance weakened. The government could not ignore the damage. Restoring stability required response. The Bank of England intervened cautiously to contain systemic spillover. Liquidity support prevented broader banking collapse, but reputational damage persisted. The South Sea Company survived as a legal entity. Its speculative aura did not. The public narrative shifted. The bubble was no longer seen as innovation. It was described as deception. Wealth had been concentrated during ascent. Losses were dispersed during collapse. The redistribution was uneven. Elite exposure did not eliminate structural privilege. Now Parliament faced a dilemma. Punish too severely, and confidence in governance would fracture further. Punish too lightly, and public anger would intensify. The aftermath required balance. Financial damage was measurable. Political damage was harder to quantify. The shock of 1720 did not end speculative behavior in Britain. It redefined it. Regulation would follow, but the memory of collapse lingered. The South Sea crisis had exposed vulnerability within the financial state. Debt restructuring had transformed into systemic scandal. The consequences reached beyond the market. They reached into Parliament itself. The political response began quickly. Public outrage required visible action. Parliament initiated formal investigations in late 1720. Committees examined the conduct of directors. Financial records were audited. Private correspondence was reviewed. Evidence of insider allocations was confirmed. Preferential share grants to members of Parliament became public. The perception of corruption hardened. Executives were summoned. Some were arrested. Assets were frozen. Property was inventoried. Estates were partially confiscated. Directors faced financial ruin. Their personal wealth was redistributed to compensate victims. The government framed these measures as accountability, yet responsibility was selective. Not all politically exposed participants faced equal consequences. Senior ministers retained influence. Institutional continuity was preserved. The South Sea Company itself was not dissolved. It continued operating in modified form. Government debt remained consolidated within its structure. The financial system required stability. Punishment could not destabilize the state further. Political survival shaped enforcement. Reform was calibrated. The Bubble Act remained in effect. Joint stock formation became more restricted. Regulatory caution increased, but structural debt management practices persisted. The episode was presented as excess rather than design. Narrative control mattered. The scandal was attributed to greedy directors. Systemic incentive flaws received less emphasis. Government endorsement was reframed as good faith misjudgment. The language shifted from manipulation to error. Public anger gradually subsided. Markets stabilized slowly through 1721. The Bank of England assumed greater prominence in managing public credit. Confidence returned cautiously. Yet the precedent had been set. Government backing had amplified trust. Political participation had distorted oversight. When incentives aligned between policymakers and speculation, restraint weakened. The accountability phase addressed visible actors. It did not eliminate structural vulnerability. The state emerged intact. The memory of loss remained. Power had preserved itself. The lesson was incomplete. Financial engineering would return in future generations. The mechanisms would evolve. The pattern would not disappear. The South Sea Bubble was not an isolated anomaly. It followed a recognizable financial pattern. Debt pressure created vulnerability. Financial innovation offered relief. Government endorsement amplified trust. Trust accelerated participation. Participation expanded leverage. Leverage magnified price movement. Price appreciation reinforced belief. Belief substituted for revenue. The company's valuation detached from operational performance. Credit bridged the gap between promise and capacity. Installment structures embedded future obligations. Political participation reduced regulatory restraint. Oversight weakened precisely when risk increased. The rise appeared rational while prices climbed. The structure depended on perpetual inflow. When inflow slowed, fragility surfaced. Liquidity supported expansion. Illiquidity accelerated collapse. The transition from confidence to panic was swift. The same network that transmitted optimism transmitted fear. Government backing had increased credibility during ascent. It increased systemic exposure during decline. The conversion of public debt into private speculation redistributed risk. Losses did not remain contained within elites. They diffused through society. Regulatory response addressed symptoms. It did not eliminate structural incentives. Future generations would repeat similar patterns. The mechanisms would evolve. Joint stock enthusiasm would return. Leverage would reappear. Political alignment with markets would recur. Financial markets are not inherently fraudulent. They become unstable when incentives reward amplification over verification. When policymakers participate directly in speculative structures, neutrality erodes. When debt is reframed as equity without underlying productivity, fragility expands. Confidence is a powerful asset. It is also volatile. Government endorsement can strengthen markets. It can also magnify distortion. The South Sea crisis demonstrated that public authority does not neutralize risk. It can intensify it. The episode reshaped British financial governance. It reinforced the role of the Bank of England. It influenced attitudes toward joint stock ventures for decades. Yet the structural lesson extends beyond 1720. Debt combined with speculation creates sensitivity. Leverage accelerates both ascent and decline. Political endorsement amplifies trust faster than evidence can justify. When expectation exceeds cash flow, imbalance forms. When imbalance persists, correction becomes inevitable. The South Sea Bubble was a government-backed scam. It was also a systemic warning. Financial structures built on confidence require discipline. Without it, stability is temporary. The pattern remains recognizable. The variables change. The incentives do not.